Let's talk about what's going on in livestock and meat markets this year. The outlook is positive. I mean, obviously you've come off a year with some real challenges from a grain price situation, some real challenges on the cost side, but one in which your revenue side looked pretty darn good. And I think you're going to see more of that this year, but a little less on the challenges on the cost. What are the key issues? Well, number one is going to be exports. We'll talk about these in specific in a little bit, but we've up 23% on exports this last year. It's been a major driver. You've got some things going on with exchange rates. You've got trade policy, which the trade policy things going on, the Korean Free Trade Agreement and such, should be positive for us this year, but it can always be a bugaboo with some of our partners. Disease status, of course, is going to be important. That was a real driver with what happened in Korea last year, but exports are going to be a big one. U.S. demand, even with exports positive, we had robust demand here in the United States the first half to three-quarters of the year. We struggled some in the last 6 months, and I'll show you that. The U.S. economy, of course, has softened somewhat. Prices of competitor goods, on the other hand, should be quite positive for pork demand as we go through this year. Feed prices, obviously a big deal. South American crops have been in the news all winter. The whole moisture situation in the Midwest is going to play into this as we go forward. 2012 acreage and yields, we still only have a projected carryout of 876 million bushels, I think. So we're teetering on the brink every year. So we've got to have a good corn crop. Going to be an issue. It's kind of a goofy report last week on grain stocks. I think is fed into some opportunities here. If you haven't got your feed covered, you have some possibilities of doing that. Hog and pork supplies, obviously always a big issue. The December Hogs and Pigs report said we're not growing very much, but we are increasing productivity, and that's going to add to supplies as we go forward this year. Herd health, always a big deal. When I go to winter meetings, everybody says, oh my gosh, PRRS has killed every pig in Minnesota. Okay? Well, no, it doesn't happen that way. And in fact, I have never been able to find a hole in market numbers subsequent to a disease outbreak in the Midwest. And there's two reasons for that. One of them is that it really isn't that different than it has been in the past. It might be on your farm, but it's different somewhere else in the opposite direction. The third one is when we get these periods where we don't have very many pigs, as an industry, we tend to just wash that out over time. And so you never see it in the numbers. And while I know some of you may be going through some very serious situations with PRRS, and I don't want to diminish that in any way, I'm telling you, we'll probably never see it in the market numbers relative to a year ago. Finally, packing capacity could get pretty tight over the next couple of years, and we'll talk about that as well. I don't think it will be a real challenge this fall, but it's going to be a little bit tight. All right, let's start with crops. Well, this whole thing was set up really by what was deemed to be a short crop, almost 6% below the long-term trend line, about 8% below what I call the biotech trend line that runs back only to 1996. It wasn't a very good crop, and yet we're ended up with pretty reasonable, I can't believe I'm saying $6 corn is reasonable, prices out of this. They're still very high. If we look at where we were, the estimates that came out last week, obviously they added a little bit to the yield, a little bit to the crop, somewhat the same change as the soybeans. The big number that drove the markets, though, was this one right here. 9.6 billion bushels still in stocks on December 1. The problem with that number is it really looks goofy when you start breaking it down to where the corn went between September 1 and December 1. And the reason is it says that feed and residual usage was down somewhere 10 to 11% from a year ago. Even though we have more hogs, we do have more cattle on feed, we do have fewer chickens, but as I pointed out in a column earlier this week, how many chickens can you feed with the corn that normally goes to one steer? And the answer is a lot. Okay, so I don't think that makes a lot of sense that we had that low a level of feed usage. In addition, USDA, when they published all these numbers, they did not change their estimate for feed and residual usage for all the year. It's still at 4.6 billion bushels. So if it was down 11% in the first quarter, what's going to eat enough to make it only down 4% for the rest of the year, for the whole year? That doesn't make a lot of sense to me. Now, with all that being said, I'll point out that these grain stocks reports haven't made much sense in about 2 years. So maybe we just have to live with it and go on. But this is what drove corn markets down last week and really offered us some opportunities. Here's the balance sheet coming out. Doggone, I forgot to change these headings. The balance sheet coming out of the January report, 147 to a 12.3 crop. Here's that 4.6 billion feed and residual, which is down 4% from a year ago. They held ethanol usage steady, actually a little lower than the actual numbers from last year. They increased exports by 50 million bushels. And so the carryout stocks are almost virtually the same as a month ago. Stocks to use ratio is virtually the same. And yet that stocks number that was in the market was enough to really put some pressure on prices earlier this week. Now, we're going to make a lot of ethanol this year. We made more last year than what the Renewable Fuel Standard calls for. The number for this year is 13.2, let me figure this back, 13.2 billion bushels, I believe, billion gallons is the Renewable Fuel Standard for 2012. It was 12.6 last year. We made more than that. And the reason we made more than that was there was margin to be made in turning corn into ethanol. The Renewable Fuel Standard did not cause us to make ethanol last year. Economics did. It paid to do it. Okay? Now, as we can see, starting this year, that might not be the case in the coming year. Now, does that mean, well, we're going to use a lot more corn? Well, we could. We've got to go to 13.2, but part of that can be fulfilled with RINs, or kind of PIC certificates for ethanol producers, that were generated on the extra amount that was blended last year. So I don't think we're going to see this ethanol usage number jump dramatically this year. I think it will go up next year. The Renewable Fuel Standard will go up 600 million gallons per year through 2015, meaning we've got to have about 215 million more bushels of corn every year just to keep the amount available for everything else the same. So that kind of puts it in perspective that this crop has to grow by 215 million bushels every year just to keep as much available for feed and residual and for non-ethanol food, seed, and industrial, and for exports. Okay, here's the usage chart. You can see feed and residual has been going down. If we add this DDGs coming out of ethanol back in here, that line is trending downward as well. So, and if I add in wheat, barley, oats, and grain sorghum, that line is trending down as well. So feed availability for the U.S. poultry, dairy, and livestock sectors is getting smaller over time because of the impact of more and more corn going to ethanol. Now, that increase is not as large as it has been. It's going to slow down as far as its rate of increase, but still, total amounts available are going down over time. I had the interesting a job last summer at a congressional hearing of pointing out to U.S. congressmen who tried to tell me that it wasn't ethanol that caused corn to go up. And I said, well, look at that chart and then tell me what was. And it was blah, 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 blah. So, unfortunately, he was from my state. So, anyway. If he had been from New York, I could have understood that maybe, but no. Okay. World corn ending stocks. Here's one of the reasons we still have $6 corn, among the lowest in history, and so very tight corn stocks as we go forward. Cash prices, of course, back up above $7 for part of last year. Here's what the futures implied as of yesterday. About $6 for the rest of this crop year, then dropping down in the $5.50 range. That number could go anywhere, folks. I mean, if we had a really good corn crop, you could buy corn at less than $5 in the second half of this year. I don't think there's any question about that. If we have problems with planting season or a drought as we go into the summer, you're going to be talking $7 or $8 on corn. So it's just it's a crapshoot here, especially from a weather standpoint. I will say this: I expect we're going to get close to record corn acres this spring, because corn has a big advantage on soybeans in most of the Midwest, and so we're going to get a lot of corn on corn as we go into the spring. So that's going to set us up for a good crop, as long as Mother Nature cooperates. This was the story last year. This was in November. After we had this severe drought in the Southwest, it kind of kept creeping northward. And that was in November what it looked like. Here's as of yesterday. Not quite as bad, but we still see some pretty dry conditions in a lot of areas here where we normally raise a lot of corn. So I live in central Iowa, just west of Des Moines. The town I live on is right on the Raccoon River. And I've lived there 18 years, and I've never seen the river as low as it is now. I mean, it's just not a lot of water flowing in it. And there are no tiles flowing in our area to speak of at this point. So unlike the last several years when we had substantial amounts of subsoil moisture, we don't have a lot of that where we are, and I think that's kind of the case up in this area too, in southern Minnesota. So we're going to be living on rains as we go through the spring and summer, and it's going to be pretty critical that those come. Unlike the corn situation, the world soybean situation is about as good as it's ever been. And thus you have soybeans quite a bit lower priced relative to corn than what we've seen in the past. I think it's going to work certainly against soybean acres. Here's the balance sheet. They really didn't change it a lot. They did add some into stocks by reducing exports and a little bit of a change of and reducing crush a bit and a little bit of a change in the crop. 9.1% on the projected carryout. Still low, but not ridiculously low, and so you're not going to see much upward pressure here. I think we're going to still buy soybean meal somewhere around this $300 a ton. This is just the futures price. I never know what basis to put on that. Sometimes it's plus, sometimes it's minus. So there's the futures for the next year. I think the guys on Chicago are betting for a steady price there pretty much, but about 310, 315, which in this part of the world you may be buying it for less than $300. I don't know that you're ever going to be wrong. If you can buy soybean meal with a 2 as the first digit, you're not going to be very far wrong in most cases in this world that we're working in. The other one that we need to watch is wheat. And wheat stocks worldwide have been replenished dramatically the last couple of years, mainly because of good crops in the Black Sea region and a recovery in Australia where they finally got some rain. But wheat stocks are in pretty good shape, and wheat prices relative to corn are almost near record low. This is Kansas City wheat and Omaha corn. If I put Chicago wheat and Chicago corn up there, it'd actually be lower. All right? So what does that mean? Well, it means that there's going to be a lot of places, even in the United States, where wheat is going to become a pretty competitive feed ingredient. Now, I don't know that that's going to happen in this part of the world because you don't have a lot of wheat around. But when we get to the Southwest, if they raise a decent hard red winter crop this year, they had a lousy one last year, and especially the Southeast with soft red winter wheat, which they fed a lot of this last year to poultry and hogs, we're going to see more and more wheat feeding. And one of the reasons is at these kind of price levels, wheat is pretty profitable in different parts of the world. And so you're going to get more wheat seeded in other places. One guy said, well, there's somebody planting wheat and harvesting wheat somewhere in the world virtually every day of the year. It's grown in both hemispheres, unlike corn, which is mainly a northern hemisphere crop. And so a lot of reasons that I think wheat can respond. And right now, you can make money at prices on wheat that are relatively cheap relative to corn. And so we're going to have some availability. So if you're not going to be feeding wheat, does that matter? Well, of course it does, because it means somebody else will be feeding wheat. And that can affect your grain markets as well. If we look at DDGs, well, we had a spike up this fall that took them out of the kind of the competitive range. Many of you in this room probably pulled DDGs out of your diets here this fall for a little while. Okay? They're back kind of in the competitive range with corn now. I think this was driven by a couple of things. One is large feedlot inventories. We'll talk about that in a little bit. And the more important one is a lot of cows still left in that southwest region on very poor grass and very poor hay. And you can throw them a little DDGs or a little supplement with DDGs in it, and it's great cow feed. Okay? It really does a nice job of balancing their diets. And so I think we had a little surge there from buying of DDGs. It's obviously it has not stayed that way. That was the thing that drove DDGs out of hog diets in the past. There wasn't enough supply, and when the cattle guys got in, they priced them out of our diet. Well, there's plenty of supply now, except for that one little spike apparently, but they're back in and competitive again. So I think still a very viable ingredient. What's your cost for this year? Average as of yesterday, using yesterday's futures, on my model is about $82 on a carcass weight basis, with the lowest, of course, being in the second half of the year when corn is low, right around $80 there. So much lower than last year, but still certainly not lower by historical standards. Any questions about crops? I think you have an opportunity. If you haven't bought corn, I think this is a catch-up opportunity as the markets have sold off here. So I think I'd think about that. I would look probably, taking some coverage on second half supplies. To me, it's kind of 50-50 whether you're going to have corn prices lower or higher, but it all depends on weather. So what do you want to do? Maybe you protect yourself from a big disaster, buy some out-of-the-money $7 calls or something like that to make sure that you don't really get eaten up, and hope that that they expire worthless. You won't have a lot in them at this point anyway. Brad?
You mentioned that the mandate won't have much effect on use of ethanol this year, or production of ethanol, but certainly the tax credit would limit the profitability of the industry in producing excess.
That's one of the reasons you saw that drop there late in the year, but that's been priced into the market, so I think it's already taken care of. The blender's tax credit and the tariff did expire at the end of the year, and so all we really have at play here is the renewable fuel standard. Now, I said, the RFS was not binding last year. It probably won't be binding this year, mainly because of the number of RINs that are going to be available. So I don't think it's going to cause us to make much ethanol this year either. Especially, and if oil stays at $100, then you're going to make $5 corn into ethanol because it pays. Okay, but I think that's pretty well in the market. It's been in the market for a while. Yeah. It'll pay even without the blender's tax credit. And if it doesn't, they'll quit bidding as much for corn. Okay? But the value of corn is still over $6 going into ethanol right now. So they're going to stand in and buy it. Demand. Obviously, rough time for the economy in 2008, 2009. We've had some recovery. That's been very anemic in recent quarters. It'd be good to have this GDP growing at a faster clip. And it is improving, though, so I think that's important. Real total disposable personal income declined in 2011. Not a good thing. I mean, even as the recovery came out, we kind of fell back into that. If we look at it on a per capita basis, we're about the same as we were in mid-2006, and about 4%, a little over that, below the peak of back in late 2007. So per capita disposable income declined in 2011 as well. And so we can see why we would have some problems on demand here in a number of places. The savings rate went down as we went through 2011. Not a good thing necessarily, but I think it's one out of necessity by consumers. They're to keep spending up. If your income's going down, the savings rate can't stay. Now, it's still well above where it was pre-recession. And I hope we return and stay in this 5 to 6% range longer term, even though in the short term, anything that's saved is not spent, and that's not great for consumer level demand. Unemployment has fallen down into the mid-8s by the end of the year. A little bit of a rebound in the University of Michigan's Consumer Sentiment Survey. I put these on the same graph just to show how negatively correlated they are. And I can tell you, until we see some improvement in the unemployment rate, I don't think we'll see a real big rebound in consumer sentiment. But we are getting a little bit of help. One thing to watch on unemployment rates is obviously that's a ratio of the number of unemployed to the size of the workforce. And another number that you always need to watch is how many jobs, how many were employed, because the first two of these declines were a decline in the unemployment rate, but the number of employed people went down. And the reason the rate went up was the total labor force went down faster. The last one was a decrease in the rate and an increase in the number employed. And those are the two things. That's what we really need to see, is we need to see more people working and a lower percentage of the workforce out of work to see some real improvement here. This is kind of played into meat demand. The meat demand is still up for the year. It improved from December through November, but these numbers have been getting progressively smaller as I've moved 1 month forward all year. So we started off very robust. We've kind of been slower and slower. Still positive numbers for all three for that 12-month period, which is the last observation here. But those have been getting lower, and you can see it in these charts, especially in chicken, which has fallen out of bed the last 3 months. When I compare just the month to 1 year before, this will be November this year versus November last year, down 8%. Pork has had 3 or 4 pretty soft months here. Beef has remained relatively strong. And this one is driven by big reductions in output, big reductions in total domestic disappearance, and no positive movement of prices. Okay? So that says that the demand has softened. We've had to put more on the market. We've taken more off the market, but we can't get the prices to go up. And so that will rectify itself eventually. I think they're going to get some price action. But still, if we look at these, we can see that what was a pretty strong demand situation the second half of 2010 and the first half of 2011 has certainly softened as we've gone to the end of the year. What does that mean for the coming year? Well, I think we're lagging what's going on in the economy somewhat. If we can keep GDP coming up, these could turn around sometime in the first, second quarter, and I think we'll see some strength toward the end of the year. But it's going to be a little bit tough here for a while, especially until these guys get some price traction. I mean, until they get their prices up, demand is going to probably hurt on the pork side as they're a major competitor. The restaurant business has picked back up. That's a good sign. The Restaurant Performance Index above 100 for the third month in a row in November, and so there's some help coming in that facet. Here's the retail meat prices, and of course we have record high meat prices for choice beef, all fresh beef. We're close to record high on pork, but look what's happened to chicken. They have just gotten no response at all from a price standpoint, even though they've been making some large cutbacks. The one that we need to watch, I think, a lot of things on exports, but the dollar index, this is a measure of the strength of the dollar. Of course, the dollar has gained strength over the last half of 2011, largely because of the European situation and the euro and the Greek debt situation. This index is about 60% euro and about 40% other currencies, and the real is not in there, the Brazilian real. The Chinese yuan isn't in there because it's pegged, it doesn't float. Okay, so you got to remember that this thing is very sensitive to the euro and not very sensitive to a lot of our other currencies that are important to U.S. pork producers. Here's our competitors, and you can see that the dollar gained value, but has lost value, but has gained some value recently, especially against the real, a bit against the euro, and somewhat against the Canadian dollar even. So that makes us a little less competitive than we were 2 or 3 months ago. And if those trends continue, that would be a negative for exports going through 2012. Now, do I think the dollar is going to roar out of here and be strong? Heavens no. We've thrown too many of them into this economy over the last 3 years for them to have much value. I mean, the supply of dollars is going to be large. Those dollars still are not moving very much. They're still sitting on balance sheets of companies. I mean, we have companies that have a lot of cash, and they're not spending that cash. We have banks that have a lot of cash on their balance sheets, and when that starts flowing, I think we'll see the dollar weaken some, but it hasn't yet. So far, the dollar has been really a barometer, this dollar index, of problems in the European zone. This was the recession. Here's the first Eurozone crisis. Here's the next one. I think this was Ireland and Portugal. Here's Greek number 2. And here's the echo of that one. Notice a couple of things. One of them, the impact gets smaller all the time. And part of that is we expect it. Number 2 is the Euros, they have, I guess they're kind of handling this better, Kent, but I don't know. The better just says how badly they did at first, I think, really. But still, the dollar has strengthened some. As I wrote a couple weeks ago, a stronger dollar, though, is the far cry from a strong dollar. And so when you're coming off the bottom, some strength there. Still doesn't mean that we're going to be priced out of many markets. Here's our customers' currencies. The one of major concern here to me, of course, is we've really gained a lot of strength against the peso. And if we look at exports to Mexico, they're just barely at the level of a year ago through November. They've really struggled, especially in the last 4 or 5 months, as the peso has lost value. But here's the yen, of course, almost record strong. The Chinese currency, the yuan or the renminbi, continues to gain value and would gain substantially more value were it allowed to float on currency markets. The Chinese peg that to the dollar, and they have slowly let it gain value, and it has gained, if you look, about 20-25% in the last 6 years, but still most economists think it would gain tremendously if they let it float. Now, because of that, they're probably not going to let it float. We've been doing some more saber rattling on this topic, and the Euros have been a little busy with their own problems to do much saber rattling, but the world is going to put more pressure on China to float this currency. They would have to really be careful about it, because if you just automatically floated it, you would raise the price of Chinese goods dramatically. And that would certainly slow down their economy. And if I'm a communist in charge of 1.3 billion people, I don't want them marching in the streets. Okay? Because I don't have enough bullets to kill them all, I guess. So, but it would be it would be a serious blow to their economy. Now, on the other hand, it would add tremendous buying power for their consumers. I mean, it would be a terrific thing for those of us who export products to China. But don't expect to see it go very quickly, even if they decide to move a little more quickly than they had. Exports up 23% for the year. Can we gain in 2012? I don't know. I put the headline here, and most likely in 2012. This is a forecast from the Livestock Marketing Information Center. I think USDA has exports up just a bit for next year. I'll say right now, if we can hold them at this level, it'll be a victory, because of the real big surges we had from China, which was the #1 market in November. That's not very many times that's happened. They beat the Japanese. Of course, that's a big driver. Korea was a big driver earlier in the year. Here's Mexico, and you can see that they haven't really performed very well relative to last year. Japan just keeps going up, and is still by far our #1 value market, because they buy very high value products in general. So, excellent year for exports. I think it's going to continue. I would say, though, this next year, if we end up with the same numbers for 2011, we'll probably be very happy when we meet 1 year from now. That's going to be a pretty big victory. Questions? Could be worse. You could be in the chicken business. This is estimated broiler returns since January 2007, and you can see they had pretty good years, so they decided, well, we'll raise a whole lot. They lost some money, come out of that, returns were good, let's expand, and they got caught with high corn prices here and more product on the market, and it's really been a bloody deal. 3 or 4 companies bankrupt, one of them a liquidation bankruptcy, not a reorganization. The situation at Tyson and JBS Pilgrim has been, they've kind of supported their chicken habit with their other businesses the last couple of years. It's really been a bad stretch for them. They do have this number back close to break even, and so I think we're going to see them make a little money this year. Here's the reductions. The red line is last year weekly egg sets. You can see when they started reducing relative to the year before. Back in May, some big 7, 8, 10% reductions here in the fall. There's where the first 2 weeks of this year are, down 6%. Here's chick placements, the same pattern. Of course, started about 3 or 4 weeks later. Much lower placements relative to a year ago. Here's so far this year down about 4%. But all of that has been kind of offset by weights. These heavier birds have kept production at about the same level as the year before, even as slaughter has gone down. And this is a two businesses in one in the broiler business. There's the small bird that gets cut up into parts for Kentucky Fried Chicken and the deli at your grocery store and da-da-da. And there's the big bird that gets boned out, mainly for boneless, skinless chicken breast. Which, if you've bought any of those lately, you think that they sent you a whole turkey instead of just a boneless, skinless chicken breast. They're huge. I mean, and that's, in a nutshell, one of the real problems here. They have put so much breast meat on the market that breast meat prices have been just horrible. Here, I'll show them to you. Here's where they've been. I mean, down less than $1.30. This is a product that not very many years ago brought $2 a pound. Okay? Now, it's climbed up above right at $1.30 the first 2 weeks of this year. There is some improvement in it, but still, they have a lot of that product on the market. Leg quarters, and at this time of year, wings, of course, going into the Super Bowl. This is the best time of year for chicken wings. As far as prices, have pushed the cutout value up above 90 cents the last couple of weeks. So that's very encouraging. But until they get this product off the deck, it's going to be pretty tough sledding for the chicken business. Now, when they do, and I think they have to at some point, this will be very positive for the pork industry, because chicken prices are going to be high. We are a very strong competitor there at the retail level. Okay? Cattle and beef, smaller. I've repeated that line for like 4 years now, and I'll probably repeat it for another 3. When the January cow herd comes out, I think it'll be published in about 2 weeks in the cattle inventory report, it could be down 2 to 2.5%. And that is a huge change in the beef cow herd. And all of it was really driven by the drought, but the smallest cow herd We've had the 4 smallest calf crops on record. We're going to have a 5th smallest calf crop on record this coming year. And here was the driver. This was in June, this severe drought that stretched all the way from the Carolinas to Arizona at the time. A few weeks later, we had a swath cut through it, that drought by a hurricane. But these conditions in Texas and Oklahoma, oh, by the way, this was 44% of the cow herd from there to there. Texas and Oklahoma is about 27% of the cow herd, and that persisted all summer. I was in Oklahoma in late July at the Cattlemen's Convention, and it was not a fun place to be. I mean, the topic at the convention was where can I get some trucks to either haul cows to slaughter or try to haul them somewhere where I can find some grass. In a lot of places there was no water. The ponds and tanks had dried up, and so there wasn't any place for them to drink. So it's been a very, very difficult situation, and that's been the main driver here. It also drove cattle on feed numbers. We saw cattle on feed numbers go above a year ago last winter, and the reason was there was no wheat pasture. We saw them jump above a year ago again this summer, and the reason was there was no pasture, okay, for these calves, and so they got placed. They're 4% above the year ago levels on December 1. It's really hard to predict slaughter patterns out of this because these cattle were placed so light, and so you've got these big numbers, and yet if we look at slaughter, 11 of the last 13 weeks we've been below a year ago. We've run all these higher numbers on the feedlots, but we're not killing as many cattle. And we're going to eventually get through those feedlot numbers as we go into the spring. But once this group of cattle is gone, there's going to be a pretty tight supply of feeder cattle behind them. And we're going to see very high calf prices in 2012, higher fat cattle prices. We're going to see some fed cattle prices in the 135 to 138 range, I think. I don't think that's out of the question at all. Here's the cow slaughter numbers, up about 12% in the second half of the year. For the year it was up 4%, but even at the end we were still killing more cows than we did a year ago. If you take reduced output and increased exports, we're just steadily shrinking the amount of product available to U.S. consumers, and that's going to be quite positive for beef prices. We set a record for choice beef prices back in November at $1.96 and change. I think we're going to hit $2 probably February, somewhere in there, and for sure, in my mind, by March on this choice beef cutout. And you could take this thing as high as $2.25 or $2.30 probably in the summertime rally. So higher beef prices, they're already record high retails, they're going to get higher, and so we're going to hear more and more wailing and gnashing of teeth from consumers, but it's going to be a positive thing for pork. Chicken and beef going up in price is going to allow us some real space in the retail counter to price pork. Okay, pigs. Not a lot going on in the breeding herd. A little bit of growth in the December report, about as expected on most of these numbers. The only one that was really different was this 180 and over number, and the pre-report estimate was way too high because this number really agreed with slaughter pretty closely. A couple of interesting numbers to me. One of them was March-May intentions at 99.1 on a 100.4 breeding herd, and the fact that we actually slowed the rate of growth in litter size in this quarter down to 1.1%. Now, that doesn't mean that the trend has changed, but we're continuing to do more with less or the same amount of sows. This is the breeding herd. Here is market hogs market inventory, and you can see the surge there in 2007 and 8 when we had circovirus, some growth, and circovirus vaccines both really helped that number, but we've kind of fallen back on this trend now. The trend in litter size still up about 2% per year for the last 4 years. In spite of our 1.1% number for the fourth quarter, I still think we're on this faster trend. Everything I hear is that people are really growing productivity. We have pretty good herd health in spite of some PRRS problems. We have genetic progress being made and genetic progress being pulled back to the farm level very quickly because of the value of sows. And so I think we're going to keep this thing going pretty quickly. If we look at what those numbers mean for slaughter for this year, larger slaughters in the first 3 quarters, about the same in the fourth quarter. Now, this is driven by that kind of curious March-May farrowings number, though. So, if anything, I think that these numbers could be a little low for the fourth quarter, and we challenged slaughter capacity this last year. I think we're going to really challenge it again in the fall, and if we get any growth at all over the next year, the fall of 2013 could really be tight. I think that's the one I'm more concerned about than I am this year. Weights are remaining high. After the big surge a year ago last fall, we thought, many of us, and me included, thought, well, this was driven by slack space and much better quality corn, and we'll get over this and we'll drop weights back. Hadn't happened. We stayed up all year. We had a little bit of a dip in the summer when the hot weather hit, but these pigs are just growing faster than they used to, and we're taking them to heavier weights. We're going to have some more facilities available as we go through the spring with more finishing barns being built. And so I expect weights to stay about the same as last year, and maybe a little higher for the year because they could stay higher in the summertime. The cutout value stayed above $90 for virtually all year, right in the 80-85 range here, to match last year's performance. I mean, the keys are going to be the demand factors. Domestic demand and exports are going to be really what we have to watch as far as these prices go. Producer sold negotiated net prices spent the entire year above $80 except for the first month back in January. We started this year, and notice we put a little pressure on packer margins here in the last couple of weeks. But still, they've been pretty aggressive bidding hogs in spite of that. Sows have been a big story, nearly a big portion of the year above $60, and I think they might spend almost all year this year above $60. And for those guys that kill sows, this is a real problem because there's just a smaller and smaller pool to draw from, especially these big sows that it takes. Many of you don't find that a profitable way to use expensive corn, and I don't blame you one bit. But still, this kind of dollars for sows is going to encourage pretty rapid roll on the breeding herd. When you sell a sow for $300 plus and buy a gilt, Irv, I think you'd have enough to go buy dinner a couple of times out of that deal, okay? And so if you're going to do that, that means you're going to be adopting very good genetics very quickly. And I think that's one of the reasons we've seen litter sizes grow. As of yesterday, those $82 costs and the futures prices suggested by Lean Hog Futures would have average profits for this year at about $14 a head. And that's a pretty good number. We've had a few years better than that, but not very many. So that's what you could do yesterday. Now, do I think you ought to pull the trigger on that? Well, we'll talk about that in a minute when I talk about price forecasts. I don't think the futures are ridiculously high by any stretch at this point. Here are my slaughter predictions, up 1.7, 1.9% the first two quarters. Some kind of goofy numbers in the third and fourth quarter. This number is down only because there's one fewer slaughter day in that quarter. This number is up only because there's one more slaughter day in that quarter this year relative to a year ago. For the year, up 1.3%, kind of in line with LMIC in Missouri. Iowa State doesn't have any forecast at the present. They've found my brethren at Iowa State have decided that they don't need to get in a rush to replace John Lawrence. He's just been gone over a year. So last I checked, hogs were still important in Iowa. I don't know, but apparently not. Price forecasts, here's mine. 85 to 89, we're going to have to stretch a little bit to get there for this quarter where we started. Up in the mid-90s for the summer, 81 to 85 for the fourth quarter. Year down slightly from a year ago. Here's what the future said as of yesterday. I should have said 118. Kind of right in the range of my predictions. So I'm sitting here going, that's not far enough to the top side that I'd be saying this is a real pricing opportunity. Now, locking in an average for $14 for the year is not a bad opportunity across the board. And so doing that on a portion of your hogs might be a smart thing. And as Professor Grimes always said, hope you're wrong on the rest of them. So here's monthly price forecast. I took those quarterlies and just extrapolated them. I think we're going to be a little higher than a year ago here. But the fourth quarter, we're going to have to struggle a little bit to get into that range. So pork outlook. 2012 supplies a little larger than a year ago, with the bulk of that in the second and third quarters. Fourth quarter steady with 11 as it stands right now with those farrowing intentions. Now the good thing is we'll get 2 more reads on those March-May farrowings before we have a solid number on them. They could go up some. I wouldn't be surprised by it. Weights, I think they're going to remain high, probably about the same as a year ago, except in the summer right now. Will it get hot enough to really impact weights negatively like it did last year? Who knows, but we could keep those weights a little bit higher than last summer. Prices much like 2011, mid-90s in the summertime. Questions? I think the biggest question is, will demand hold? I mean, we've had the import situation. Domestic demand, it was good early. Will it recover? Competitor prices should be positive. The U.S. dollar, I don't think is going to be a big negative. The economy, who knows, but I think that could be a positive. Consumers and their viewpoints, how people feel depends on a lot of things. And so some consumer sentiment issues could come into play. Is there enough finishing space for added pigs? Well, a mild winter, I hear, has gotten us some buildings built this winter, and I think we're going to get more of that this spring. We were certainly tight on finishing space last year. And then, of course, the issue of slaughter capacity. I don't think it will be a real big one for the fall of 12. I'm concerned about the fall of 13 because even if you started right now trying to expand a plant or build a new plant, you probably wouldn't do much before the end of 2013. So we're kind of past being able to impact that by much. The risks, the economy in general, both here and abroad, is a major risk. One way it's going to play out is with exchange rates. We're always at risk with each year's corn crop given the size of our carryout stocks. Oil prices, obviously a big deal. Corn is hitched to that. We get in a shooting war over the Straits of Hormuz and oil goes to $130 or $40 a barrel. It's going to make ethanol really valuable, and they're going to be able to bid like mad for corn if they have to. RFS waiver reduction plan. This piece of legislation is pending in Congress. Depending on who you talk to, one guy says, it won't pass, and others say, it'll pass easy. So I guess it's kind of a 50-50. Proposed by Congressman Goodlatte from Virginia and Congressman, I'm looking for his name, from California. I'll think of it here in a minute. But what it says is projected stocks to use ratios hit certain trigger points, we will reduce the renewable fuel standard for that crop year by a given percentage down to 50%. Okay? And what it's designed to do is to give us an off-ramp in the case that we have a short corn crop and low oil prices. Now, last year, that piece of legislation would have said reduce the renewable fuel standard by 25%. But it would have had no impact on the amount of corn made into ethanol because why? Because we weren't making ethanol to meet the renewable fuel standard. We were making it to make money. And we were doing that because oil was $100 a barrel. If oil is $100 a barrel plus, it's not going to matter, okay? Because whatever the price of corn is, we're probably still going to make ethanol. But if we ever get in a situation with a short corn crop and $60 oil, then the market's going to say burn gasoline and feed the corn to livestock, but the legislation won't allow that. And that's what this would prevent. So I hope it passes. I don't know if we'll see a circumstance where it really comes into play, but it'd be nice to have that. We do have, I talked to somebody earlier this too, said, well, there already is a waiver provision. Yeah, it's a waiver provision, and it says that the administrator of the EPA, who I'm sure is out looking out for the best interest of hog producers, may waive the renewable fuel standard. This one says the administrator shall waive the renewable fuel standard, and that difference of one word is pretty important. Okay? So I think it's really important. Export disruption obviously is a risk. Don't like to think about these, but we have to recognize that something could happen like that and count it as a risk that we might have to deal with.